I would like to extend a warm welcome to everyone. Thank you for joining us for today's webinar on aligning operations to protect value during COVID. My name is Joanna Sirkowski, and I am the moderator for today's session. We have an hour set aside to discuss many of the challenges that private equity owners and leadership teams are facing in their operations. I am joined by two of my colleagues, Tim Ristoff and Scott Sparks. Tim is the founder and CEO of TriVista. With over 25 years of industry experience before beginning his consulting career, Tim brings extensive Fortune 500 operating expertise to TriVista's clients. Whether evaluating operational performance during due diligence or assisting leadership teams with strategic initiatives, Tim's background as a practitioner brings a unique and highly valued approach. Tim is widely recognized as a pioneer in the field of operational due diligence, having led hundreds of engagements for many of the world's leading private equity firms. Under Tim's leadership, Tim and TriVista has been recognized by Consulting Magazine as one of the fastest growing management consulting firms globally. We are also joined by Scott Sparks. Scott has 25 years of business strategy and operations experience gained through industry roles at Fortune 500 firms and in top-tier strategy consulting firms. Scott is a senior managing director and oversees the firm's supply chain practice. Scott's team is focused on optimizing manufacturing, distribution, and transportation operations, consolidating, relocating, and improving facilities, reducing costs through sourcing and procurement best practices, and improving market responsiveness through more effective inventory and operations planning. Scott is recognized as an expert in supply chain strategy and operations management. The global pandemic has created an unprecedented business environment. Most companies are navigating through numerous challenges and uncertainty, including demand fluctuations, market changes, supply chain shortages, and labor challenges. Scott and Tim will discuss a few areas on which to focus to protect value. They will share thoughts on rationalizing SKUs and customers, right-sizing considerations, tips on securing and de-risking your supply chain, and processes to manage demand variability. Throughout the webinar, we will have a few polling questions for those participants who have joined via the Zoom application versus your browser, and we will share the responses to those questions toward the end. Also throughout the webinar, please submit your questions for Tim and Scott via the Q&A panel, and we will save time to respond to those questions at the end. So with that, let's get started. So Tim, as you've had conversations with private equity firms and business leaders, what have you heard?
Well, thank you, Joanna, and good morning to everyone. Thank you for joining us today. You know, I think in all the conversations I've had with the different private equity firms and CEOs, I think we would all agree that most companies will need to make some immediate and longer term changes in their operating model to really remain profitable and grow because of this very disastrous pandemic. And I think we'd probably all agree that, you know, very few PE investments are going to deliver strong returns without implementing transformational changes. So because of this, because of these conversations, you know, we thought it might be helpful to share with our clients and our friends in the manufacturing and distribution community what we've learned over the past 30 years as operational practitioners and advisors as it relates to significant market disruptions. You know, Scott and I, we've had kind of the unfortunate or fortunate experience of working through 4 very disruptive business environments. You know, we dealt with the 2001 dot-com crash, the unfortunate tragedy of 9/11, the 2008-2009 financial crisis, and today, the very difficult and sustaining COVID-19 crisis. You know, each of these unfortunate events impacted the world, our country, our businesses, our communities, and our families. And each event was unique and brought with it a set of unique challenges. However, there were also several common challenges. First, there was a dramatic change in demand, both locally and globally. Second, there was a very unclear recovery horizon from months to years. And I think that's the one that's really sticking in our minds today more than ever. And third, there was uncertainty around who was going to weather the storm and who was not going to weather the storm. So as a firm, we've been reflecting on these, and we've been reflecting really on why some companies prevailed during these times of crisis and others didn't. And really there are some obvious questions around, while there are some obvious questions around a company's debt level and amount of liquidity available to weather the storm, those are all normal things that we think about, and I know that all of our PE clients think about daily. But we also need to think about how we're aligning our operations around this new reality and understand the questions that we need to be asking ourselves. And if you're like most companies and most investors, you've really spent the last several weeks focusing on cash flow modeling to improve liquidity. I think everybody was focused on that the first couple of weeks. You've been working with your banks to communicate your assessment of your company's risks or your portfolio company's risks and opportunities. And unfortunately, right, the last few weeks in my conversations with CEOs and private equity executives, they've been adjusting headcount levels to make sure that they can survive in the near term. But I think the real issue is, what's next? These were the fundamental things that we had to focus on. You had to make sure you had liquidity, and the people on this webinar are probably some of the best in the world at making sure that they understand cash flow modeling. Second, you had to make sure you had that good communication with your banks. And third, you had to have the unfortunate conversations recently with some of your team members about right-sizing the business from a headcount perspective. But as we think about what's next, we thought it would be helpful if we shared with you some of the biggest operational risks outside of aligning staffing that you need to focus on to help protect your company and advance it. And make sure you're focusing on the right activities to create that both near and long-term value. So Scott, as a leader that has really experienced a lot of these social and economic crises of the past, much like I have, when you're speaking with CEOs, when you're speaking with boards, what are you encouraging them to really think about operationally? Going beyond the initial response of, hey, you got to have liquidity and you got to right-size your headcount. What are you asking them to think about?
Yeah, thanks, Tim. Yeah, when the effects of the COVID crisis started to take hold a few weeks back, we saw most PE-owned companies doing an excellent job at getting immediate control of cash, as you mentioned, and managing variable costs, labor costs included, to survive in the short term. But as this crisis wears on and it becomes clear that in most industries, we're going to have to manage through months, if not weeks, of much lower and more variable demand, we look back to the lessons learned from some of those previous economic crises that you mentioned. And what we found is that the companies that performed best did make the easier short-term decisions to quickly control cash, by extending out supplier payment terms, paring back labor and other variable costs in their manufacturing and distribution networks. But even more important, they made the more difficult decisions early in the crisis to manage down the big fixed cost and refocus limited company resources only on the products, markets, and channels where the most profit or EBITDA dollars are made. And these tend to be the much bigger levers on profitability and company value in the longer term. So as we went back and, we started to kind of collect notes from all these conversations, as you mentioned, with PE firms and executive teams of their portfolio companies, we put these lessons learned into four big buckets. So first, refocusing your variable sales, operations, and inventory investment resources on your most profitable business. And for many companies, that starts with taking a closer look at your true or fully allocated profitability of each product, and even down to each SKU. And it also means making the real hard decisions to rationalize or temporarily shelve the products that are destroying value, particularly in the current market where lower sales volume or pricing may have moved products that were winners a few months ago into the bucket with other products that now have negative contribution margin and are destroying enterprise value. And then second, looking beyond quick hit cost reduction and looking more closely at facility and supply chain network fixed costs. And for some companies, this can include making overdue adjustments to back office or indirect staff levels, but really the bigger levers tend to be in the physical manufacturing and distribution infrastructure. And this typically means optimizing your network design by rationalizing the number and location of rooftops. Past experience tells us that optimizing the network really can be one of the longest levers, in some cases by far, on profitability during a sustained revenue downturn. And then third, securing supply and taking risk out of your extended supply chain. This means looking beyond your immediate suppliers upstream into your supply chain. It means checking the health of each player in your supply chain and developing contingency plans to ensure continuity of supply. But it also means controlling costs in the longer term as country-specific costs vary when the next crisis hits. I think none of us probably believe that this is going to be the last COVID, the last wave of tariffs, or the last situation where we've got, rising and escalating labor costs in certain countries. So, preparing for the longer term becomes really critical. And then last and finally, putting the processes in place to be able to constantly react to a new variability in demand and to quickly ramp up supply when the economy begins to open back up. And one of the more powerful weapons on this front is having strong SIOP processes, or SNOP, whatever language you use inside your company, in place to get visibility into the changes that are coming down the pipe, but also being able to react to it in a way that constantly balances supply and demand in the most efficient and cost-effective way. And this allows you to meet your service level targets in on-time delivery and lead time, keeping your sales volume up while reducing your variable cost of production through level loading the factory with better supply planning.
Hey, thanks, Scott. I want to take the time to walk through with you each one of these buckets in a little bit more detail, because I think people probably listening in on this webinar would say, listen, I totally understand right sizing, and I got to think about that. But how does rationalizing my business, how does securing my supply and demand planning really have a strategic and relevant impact on my business? So let's start first with rationalizing. I think it's really a natural reaction of most operational leaders and executives within a business to say, why would I ever rationalize my product line or my SKUs, especially today when I need every single order that I can get? Those orders are going to cover some of my overhead costs. Even if they're low margin, they're going to help generate necessary cash. I mean, I've heard that 1,000 times in my career, and I think people are going to be saying that today. So, Scott, how do you respond to that concern? Why is rationalization a good idea in today's difficult environment?
Well, the quick answer is not every product or SKU is going to generate positive contribution margin to cover any of your overhead costs. And particularly in the current market where lower sales volume or lower pricing may have moved products that were really, big winners a year or so ago into, as I said before, into the bucket with other products that now have negative contribution margin and are destroying value of the company. It's amazing how powerful of a lever this can have on a company's profitability. And identifying and rationalizing the products or SKUs with negative gross margin contribution is only the start of it. By refocusing your valuable resources in your sales team, the dollars that you're investing in inventory and working capital on the SKUs that are profitable, the return you get out of this effort acts as a real EBITDA multiplier. But the challenge here is that most middle market companies' financial systems don't really give you the information that you need to understand true contribution margin. You got to start with operational allocation of your true cost of production and distribution, of carrying inventory, and the resulting operational complexity that each additional SKU drives into your organization. And you've also got to consider the time that your sales team allocates to selling more complex, low volume SKUs, for example, or pushing sales of new products versus the higher volume SKUs. And then once you get clarity on which products and potentially which customers are destroying value, the next step is to make the real hard decision to rationalize product lines. And that means putting a process in place to manage through objections from the sales organization around things like the importance of a broad product portfolio or the importance of giveaway SKUs that act as a bridge to more profitable products. And then finally, as a last step, that would be to realign the sales incentives to focus on the most important remaining profitable SKUs and products. You can have the best product lineup, but if the sales team doesn't focus on the right things, then much of the product and customer rationalization work that you put in place may go to waste.
That's great. Thanks, Scott. I think as an executive, as a PE leader, we all got to recognize, right, that our team is most likely going to be stretched thinner than they've ever been stretched before, right? Either due to headcount adjustments or to the fact that they're juggling a number of balls that they've never juggled before, right? They're dealing with the COVID crisis. They're dealing with demand fluctuations. And so that time is so much more valuable today that if they're spending their time on something that's not really creating value, but in fact possibly destroying value, they just don't have time to do it. So appreciate you sharing that insight on why rationalization today is really so very, very important. So I think what we'd like to do is, we mentioned, Joanna mentioned, we're going to be having some polling questions throughout the process, and that kind of brings us up to our first polling question. Since the pandemic, have you reviewed and rationalized SKUs and or customers? So if you would be kind enough to go ahead and provide your answer, Joanna will go tally them, and at the end of this presentation, we'll share those results with you. And then we'll move on in just a minute or so after everyone's had a chance to talk a little bit about right-sizing. Okay, let's move on. So, Scott, I've talked with a lot of CEOs. You've talked with a lot of CEOs recently, PE executives, and they've spoken, over the past few weeks about what they've been focused on, right? We talked a little bit about whether it be liquidity or what they've been focused on here the last couple weeks, I think, has been really around right-sizing headcount. And they've been focusing, a little bit more on variable costs because those are obviously two significant levers. And, making big fixed cost changes are tough. And so I thought it would be helpful if you would share with folks, what you've been thinking about. And you've certainly been outspoken within our firm and with a number of businesses that you advise on. You've been outspoken about look beyond quick hits. Look beyond the quick hits of, yes, I have to take out some of my variable costs, and yes, I have to adjust my headcount, unfortunately. But you've been pushing people to say, hey, you got to really look at right-sizing your fixed costs across the enterprise. So maybe you can share some insights and thoughts with regards to right-sizing across the enterprise.
Yeah, this exercise is really about looking beyond quick hit cost reduction and looking more closely at facility and supply chain network fixed costs. The bigger levers tend to be in the physical manufacturing and distribution infrastructure. And, this really does mean doing the difficult work to rationalize the number and location of rooftops to optimize your mix of big facility fixed cost, rent, direct labor, for example, and other costs like transportation and inventory holding costs, while at the same time making sure that you're meeting or exceeding your service level targets. And if you think about the math on this, you can spend an awful lot of time continuing to whittle down your manufacturing or distribution direct labor costs. But in most manufacturing and distribution companies, this represents less than, say 15% of sales, which, when you start whittling that down and focusing on taking cost out, that translates to an improvement of, the order of 2 or 3% of sales, if you work really hard at it. On the other hand, when you've got a lot of excess capacity and you can see that in the pipe for a little bit of time, closing or temporarily shuttering a factory and consolidating production in another facility, maybe even one that's more productive with a lower labor cost, for example, can drive out more than 200 or 300% of that. I can think of several cases during the last downturn when clients knew that they had fixed cost problems as capacity wound down, but didn't act quickly enough. And in one case in particular, we did the math to show the impact of keeping 2 versus 1 plant, both with similar production capabilities and capacities open. And, the curves showed how sensitive EBITDA margin was to shuttering one of the plants. It didn't take much of an additional reduction in revenue at all to push the entire operation into the red. And this company ended up gambling on stabilized or increasing revenue, ended up losing control of the company. That's an extreme example, obviously, but optimizing the network really can be one of the longest levers on profitability during a sustained revenue downturn.
Well, great. Thanks, Scott. And kind of continuing on with our theme of having some polling questions, maybe we'll go on to our next polling question with regards to right sizing. Since COVID-19, which costs have you evaluated for right sizing? And you're welcome to select more than one. While people are doing that, while this is many times the hardest topic to address, looking at roofline and looking at fixed cost, it is one of those one of these opportunities to right size your business for the long term, right? And to really make sure that you're thinking beyond, unfortunately, just the next 3 to 6 months, but really looking at integrating those acquisitions that you made that maybe you didn't integrate before, or even thinking about sweating assets differently than you have before because of that unknown in the future. So Scott, really appreciate you spending some time on that. So let's move on to our next topic, which is securing supply. And to me, this, as we've chatted over the last 3 or 4 weeks, to me, this has been one of the most interesting conversations, Scott, you and I have had. And I think it's one of the most impactful discussions as well, and one that every board needs to be thinking about. We hear a lot of companies say, listen, all of my suppliers today want and need my business. They're bending over backwards for me to keep my business and to keep me happy. Why in the world should securing supply be a board level conversation for my CEO and the board? Why is this so strategic for me today? And so, Scott, I look forward to you sharing some of your thoughts and words of wisdom on this, because to me, it's really something that each board and executive team needs to focus on. So, Scott, give us some of your insight.
Yeah, there are really 2 big issues here. First, it's possible that the things have changed enough in the market that some of your suppliers may actually not want your business anymore, oddly enough. Just as you were thinking about focusing your efforts on your most profitable customers, your suppliers are probably doing the same thing. At your new lower volume, the cost of customer service, disruptions to longer manufacturing runs that your change orders are driving, or the setup cost to run your smaller batches may no longer be worth it, and you may now be an unprofitable customer to them. So, in a way, customer rationalization may no longer look so good when you're looking at it from the other end of the gun. But second, it's not just about whether your suppliers need or want your business, but in the current environment, they may not be able to provide you with the uninterrupted supply you need to keep your business running. They may not be financially stable with a strong enough balance sheet to weather a longer downturn in demand. They may not have the workers they need to keep production running when the next outbreak cluster hits their local area. But in either case, major supply disruption could be the result. And this is an enormous risk in most manufacturers and distributor supply chains. Finding new high quality, qualified suppliers does not happen overnight. This could take months, which could be enough time for your customers to find other options for the products and services they need. So what can you do about it, I guess, is the main question. And, when you put both of these drivers of supply disruption together, I think we're going to see a real groundswell shift in supply chain management in many industries, from the historical complete focused on cost to more of a balanced or even shifting towards a risk focus. And, we're already seeing that. And the real question is, what can or should we do to take some of these new supply disruption risks out of our supply chains? So we're recommending that our clients do two things. First, secure sources of material and component supply. Supply chain disruption has spread across sources in almost all manufacturing centers around the globe. That's one of the unique elements of this COVID outbreak. So, check your critical suppliers' health and production locations at all levels in the supply chain, not just your immediate suppliers, but upstream to your suppliers' suppliers. Check their financial health, and I don't mean just a high-level conversation. Ask to see evidence of it. Ask to see their response plans to keep production running in case of a regional labor issue. Ask what will happen to your supply in particular and where you'll stand in order of priority relative to their other customers. How will they guarantee that you'll continue to get supply? Ask for contingency plan details at the tactical or daily level. What this comes down to really is proactively negotiating with your key suppliers or vendors to ensure stabilized supply and get it in writing, get it in a contract. In this case, the squeaky wheel will get the grease when things really do go bad again in the future. And then second, review and de-risk your extended supply chain. The coronavirus isn't the first and definitely won't be the last major issue that draws out the risks in a single-sourced or single-country-focused supply chain. Who knows when the next wave of tariffs with 20% or 30% plus cost impact will hit overnight, and we already see additional threats from the current administration on that front, or when the next environmental protection initiatives that have shut down entire industries in China will go into effect. Some of you remember the Operation Green Sword in China that shut down plating, recycled paper products, et cetera, for long periods of time. Or when government manipulation of currencies will cause unpredictable gyrations in exchange rates and ultimately your cost to the bottom line. Or even when we might see a return to steep inflation of skilled manufacturing labor rates at some point in the future in certain countries. So, the message is that we all need to develop safety net options through dual sourcing strategies, and now's the time to act. We know from the experience when Chinese tariffs went into effect a few months back that the first movers quickly locked up low-cost supply capacity in other countries, making it really tough to find suppliers with time or capacity to even answer your request for quotes. Competitors and companies in adjacent industries will quickly consume capacities as they run out to diversify their operations in other low-cost regions.
Yeah, I think that last one's very interesting, Scott. About companies in adjacent industries consuming capacity. We had, I think you're aware, we had a number of clients call us because of the need for medical equipment to be made in the United States, with the government pushing that initiative, obviously. There were a lot of raw materials that people just took for granted were going to be there that all of a sudden were not there. If you were someone that was consuming melt-blown polypropylene in the past for whatever product, all of that capacity came out of the market and went into mass production over the last 6 to 8 weeks. Same thing with bonded polypropylene, as well as many other products, for ventilators or any other type of PPE. And we could probably look at that across the spectrum. So for all of those executives on the phone, all of our PE clients, we can't stress enough to make this a board level conversation. Check the health of your supply base, check the health of your suppliers, make sure that they're going to be there for you in the long run, and that you're just as valuable to them as you are vice versa, right? So thanks for that, Scott. I think we have one more poll question, if we could. And actually it's a dual question here, or two questions. Have you checked the health of critical suppliers? Yes, no, or if you're a PE firm, you may have a not applicable. And then also, have you developed safety net options through dual sourcing? So again, these are two very critical questions. We'll share the results at the end of the conversation today. But truly appreciate you going through that and making this a high priority for executives and PE clients. Okay, so let's move on to the last topic that we have, and that's the topic around aligning with demand. I think most of the leaders, most of the CEOs that we would talk with, and PE PE leaders would say, listen, it's pretty straightforward. It makes total sense that I have to align my business with the demand that's coming in. And it should be fairly straightforward. Why are you guys at TriVista saying that this is really something critical? And why is it important to look beyond just assessing the current demand by SKU and cutting my production based off what I'm seeing happening in my business? So Scott, with that as kind of a backdrop, maybe you could share some of your thoughts around why alignment with demand is so critical beyond just the obvious.
Yeah, it's really all about trying to deal with the crazy gyrations in demand that are going on in the market right now. And aligning supply with demand in this current environment can be really tricky. And it can have a big impact on your on-time delivery, your EBITDA margin, your capital invested in the business, et cetera. Historical patterns of demand have suddenly become much more difficult to predict. Demand's dropped off the face of the earth in some cases, and it's become a lot more volatile and erratic in other cases. Shifting customer demand can cause products that were high in demand to sit in inventory, while products that were low in demand to suddenly move to the top of the sales list. And then there's the question about when demand will pick back up and being prepared not to miss the upturn when the economy picks up. Getting this right and being able to consistently match demand and supply can have a big impact on your service levels, meaning on your on-time delivery and lead times, on your inventory cost, and on your manufacturing productivity and EBITDA margin in the factory or in the warehouse. And this really comes down to having strong SIOP processes in place. And that means when we say SIOP, we mean forecasting and demand planning, inventory planning, material and supply planning, and production planning and scheduling. And finally, an executive SIOP process to wrap around the whole thing to manage supply-demand exceptions. And if you start at the front end of that SIOP process with demand planning, you really do need to be able to see changes in demand coming. Relying on historical data and patterns is no longer good enough. New forecasting algorithms and better integration of forward-looking sales intelligence is key. Obviously, if you can't see it coming, you can't plan for it. To meet your target service levels, inventory, cycle stock, and safety stock also need to be adjusted as supplier lead times become longer and a lot more variable. And as you scale back capacity, either intentionally or because you don't have the workers you need, scheduling the factory at the right pace and level can have a big impact on both on-time delivery and EBITDA margin. And this starts with understanding your new capacity at every work process in the factory, then putting planning processes in place to accept and schedule demand only when capacity is available to maintain the lead time and on-time delivery that your customers demand and to help you avoid losing any more of your remaining valuable sales as a result. And then finally, this allows you to level load the factory so you don't have to go outside for more expensive third-party outsourced production capacity when you have, if you overschedule at times, or you don't end up underscheduling at other times, which cause low manufacturing labor productivity, but really in either case, the result is can be significantly lower productivity.
Great, thank you, Scott. So we're about to wrap up here, and we're going to open it up for some questions from others that have written in either in advance or during this conversation. But we can't stress enough to the executives that are listening in and the PE firms that are listening in. I'm sure you've had your top 4 things that you've been checking, for the health of your companies each and every day, whether it's you're running the company or whether it's a portfolio company. You've been checking on the health of your team members. How's your cash position been? Are orders coming in at the rate that you think? How is revenue looking? Are we on track? Are we falling behind? Do we have the workers necessary to do that? The normal 4 questions that I think is on the top of everyone's mind. But we are asking you, based off of our 30 years as practitioners, to really consider adding these 4 elements that we've just shared with you today. The importance of really thinking through rationalizing your business, whether it be from a SKU perspective, a product line perspective, or even customers that are value destroying versus value creating for you. Number two, really focusing on right sizing and looking beyond those quick hits, as Scott mentioned. And yes, we all had to address and continue to address the headcount situation that we have and the variable costs that we have in the business, but it's really time to make those tough fixed cost decisions moving forward. And third, the securing the supply chain and making sure that your suppliers are going to survive and that they're going to be there for you to support you. And because some of them may be rationalizing you, unfortunately, or some of them might be overwhelmed with other orders. So really understanding that. And then last but not least, as Scott just finished talking about, aligning your organization with demand. A company working to survive, you got to be focused on meeting and exceeding service level commitments to your end customers now and in the future. And I think when you think about and talk about aligning your organization with demand, it has to be focused around service level commitments. How are you going to absolutely make sure that your customers see the value that you bring to them? How do they have confidence that you're going to be there for them? And how can you make sure that you emerge from this pandemic stronger and more agile as an organization? So thank you all. I'm going to like to turn it over to Joanna, and she's going to walk through some of the results of our audience poll questions, and then she'll be opening it up for any other questions. So Joanna, over to you.
Great, thanks Tim, thanks Scott. So we'd love to share the input that's come through on the poll questions. And on our first question, since the pandemic, have you reviewed and rationalized SKUs and or customers? It looks like the majority of the attendees have evaluated that with 29%. And if we go to our next question, since COVID-19, which costs have you evaluated and right-sized? And this was a multiple choice question, so folks had the opportunity to select all that applied. The responses from participants were fairly well distributed, so fairly equal between variable costs, fixed costs, and infrastructure costs, with variable costs taking the lead there. And then on our last question, have you checked the health of critical suppliers? Both that and have you developed safety net options through dual sourcing? The majority of the attendees at 39% have checked the health and developed safety net options. So thanks everyone for sharing a little bit about what you're doing out there with your businesses. And let's turn it over to some of the questions that have come in throughout the webinar. Feel free to continue to submit them in the Q&A panel if you're on the Zoom application. And so this question for you, Scott, considering the risk of lengthy offshore supply chains, like for example to China and Asia, that were originally established for the purposes of lowering manufacturing costs versus selling directly into that country's market, do you anticipate companies repatriating manufacturing to the United States? Are we seeing this activity, or are we seeing plans for this to occur with our clients?
That is a great question. There's been a lot of excitement around the potential for this to happen. And this was one of the objectives of the current administration with the rollout of the China tariffs a number of months ago. But the reality of it is we just haven't seen this play out in the numbers. But what could change this is what happens over the coming weeks here with additional tariffs in the future. And there's a lot of conversation about this coming from the current administration, that it looks like this is going to potentially become a reality again fairly soon. And second, there's talk about government incentives that could really change the cost equation for competitiveness onshore in the U.S. The real opportunity if this happens is to reconsider, for sure, manufacturing in the U.S., but also nearshoring in Mexico, for example, where you have direct manufacturing labor costs now on par with China. You have all the benefits of a shorter and more responsive supply chain, meaning significantly lower inventory holding requirements, much shorter lead times. And interestingly, on that note, just kind of diverging for a minute, we've been talking to a number of our clients that have begun to take a look at this, meaning to do the work with their sales and marketing teams to build models and estimate the revenue lift that might come along with shorter lead times. And now exceptions to this equation, are really already happening, where you have highly automated processes with very little labor content, where we're already very competitive. And you're seeing, I think, already a significant influx into any available capacity in these fully automated, low labor content processes. And then, finally, and on a related note, we're having a number of conversations with manufacturing clients that are looking ahead to not just react to this new equation with additional tariffs, et cetera, but they're looking ahead to full onshore production. And we're helping them to kind of think through this equation of how and which processes can be automated that tilt the equation even further in the direction of a strong U.S.-based manufacturing.
Oh, that's great. Thank you. And actually, the second question kind of links into that. So this question is, my key suppliers are in China. If I consider de-risking through diversification, what are the best practices to start the process to find other suppliers?
Well, yeah, there's a lot loaded into that question. The short answer is there are really three things I would focus on. Don't delay, get it done quickly. Pick the right target country before thinking about specific suppliers and not the other way around. And weight risk reduction as heavily or even more heavily than low cost in your decision criteria. Now, I guess if I stop there, you might not be very satisfied with that answer. So let me kind of quickly fill in a couple of the blanks. On the first point, do it quickly. And Tim mentioned this after one of our questions earlier, that in most industries, there's really only a limited amount of total capacity outside of China. And the first movers and anyone else that gets in line with an RFQ in front of you will lock it up pretty quickly. We did a manufacturing capacity study by country a few months back when the first big wave of new tariffs was just going into effect. And what we found was that it would take only, I don't have the numbers in front of me, I don't remember the exact numbers, but it would only take a couple of percentage points change in manufacturing volume flowing out of China to swamp all available capacity in all adjacent low-cost manufacturing countries. That's a pretty heavy duty statement. And when you think about what the impact of that is when a crisis hits, and that includes, when I say adjacent countries, I mean not just physically adjacent, but that includes Vietnam, Malaysia, Thailand, Mexico, Eastern European countries. China has just become such a huge power horse of manufacturing volume that when you start messing around with volumes flowing out of China for whatever reason, things get crazy when demand starts to flow into these other countries. And these numbers align really well with the difficulty manufacturers are having with finding supply sources and with capacity outside of China, more so than they did pre-tariffs and pre-COVID. And second, maybe double clicking on that second answer, picking the right target country before you dive down into the supplier level in your search is really important. The reason that most companies got into the problems that they're in now is because they're in the wrong country at the wrong time. So, start with a filter on countries that have centers of expertise in the manufacturing processes involved in the production of your products. Then look at how all the factor costs in your products align with the cost in each potential target country. And what we mean by that is, if raw material commodities are a big driver of your cost, for example, look at the historical cost of these items relative to other potential countries. Some countries manipulate or subsidize commodity markets, for example. Look at your mix of direct versus indirect manufacturing labor. The relative costs of these can vary from country to country. Mexico, for example, great, super low direct wage rates and on par with China, but indirect manufacturing management rates are significantly higher. And then finally, look at the total cost of the extended supply chain from country to country. How much will the inventory on the water and extra safety stock that you'll need to hold how much will that cost you? for a China versus a Mexico supply decision? And what will the impact on sales be if you can take 2 weeks out of your lead time with a nearshore supplier? So country, super important. And then last, the balance of cost with risk in your country and supplier decision process is super important. Don't make the mistake of diving quickly in. Setting up the output of your cost reduction model as the main decision criteria, like we've all done in the past. At this point, it's much more about ensuring continuity of supply and protecting against future swings in cost through dual sourcing and other strategies. So, look closely at country-specific geopolitical risks, infrastructure stability in the longer term, historical gyrations in exchange rates and labor cost trajectories, for example.
Great, thanks, Scott. And maybe we've got time for one more question here. So with COVID-driven market changes, our demand right now is highly variable. I know that SIOP can help us better prepare for variability of demand, but I'm having a hard time figuring out exactly how big the benefits will be. What are your thoughts on that?
Yeah, this is a tough one because the benefits really can vary a lot by industry and for any specific company situation. But, we did put together a few numbers that I'm pulling up here for a recent client conversation. And we've got a few general benchmarks based on our experience helping companies improve their SIOP processes. And, if you look at what you get out of an improved SIOP process, one of the overall objectives is, as Tim had mentioned, is improving in the current environment when you've got all these crazy gyrations in demand, things you didn't have to deal with in the past, improving service levels, on-time delivery, and keeping your lead times down to an absolute minimum. And the overall objective, obviously, is when you accomplish that through better demand, supply, and inventory planning, is to drive revenue lift. And this is one of the probably more controversial questions: is what does that really mean? And we've sat down through visioning sessions with a number of our clients to try and put numbers around those projections. And we're seeing numbers lie anywhere between sort of 5% lift on the low end up to 15 plus, even significantly higher for some clients. But even at the low end, if you can drive 5% revenue lift, the payback on fixing up your SIOP process is to be able to get yourself in the position that you're a leader in the service levels can have just a huge impact on company value, et cetera.
Scott, can I jump in on the thing with that? I think it's really important for people, especially with cash being in the being king right now. But I know some work you did just recently with your team on really optimizing the SIOP process to help improve the factory loading and factory planning, and how that had a dramatic impact on reducing the amount of CapEx spend necessary in the forthcoming years. And I think today, where everybody's been looking at cash, right, there's that positive benefit of improving factory load and utilization, reducing the amount of current CapEx. So I don't know if you want to share anything additional on that as well.
Yeah, no, that's a great question and a good segue in kind of the second of the three big benefit levers. So whether you're scaling back your production volume to deal with a much lower demand projection and sort of retooling your factory or resetting the capacity in there, or whether you're, in some industries we even see demand picking up, whether you're trying to figure out how to set up the processes for more demand. In either case, if you don't have clear visibility into your production capacities at every step in the process, what happens inevitably, and what we see happen with most of our middle market manufacturing clients, is that they're starting off in a situation where they don't have the ability to kind of dynamically look at capacities in the factory, et cetera. And what ends up happening is that you end up overloading the factory in certain times. Orders come in, order entry kind of says, yep, sure, we can run that. They don't have the models in place to look at when they can actually promise that delivery date, and when capacity is available in the factory to optimize your productivity and your EBITDA margin. It's just, yep, we'll do it. And so what ends up happening is you overload the factory at certain times when your orders just happen to pile up. A lot of companies go outside for production capacity, or they end up running overtime. In either case, it's a heck of a lot more expensive. And then at other times you're underloading the factory. And so, what happens then? You got poor absorption, you got a lot of overhead sitting around, you got poor productivity on the variable labor costs that you've got in the factory. And you have a big overall impact on EBITDA margin at almost all times in the factory. And then, just last but not least, there's, so that's your sort of your EBITDA margin expansion number. Oh yeah, and back to the numbers. This thing is, this is also another tough one to estimate. But if you take just the impact of what we just talked about, being more efficient in the way you schedule into your factory, your master production scheduling process, for example, through better SIOP, that lever alone, forget about the revenue lever, drives significant EBITDA margin expansion. And I'm just going to take from a recent client example. We're pushing towards 2% plus from the manufacturing productivity improvement only. But in the past we've seen those numbers go up significantly higher than that. But even at 2%, again, can have a real impact on your enterprise value. And then the last lever is inventory reduction. If you get your forecasting algorithms retuned to the current environment, if you're taking that sales intelligence, which becomes so important in the current environment, backwards looking data is, in a lot of cases, has lost a lot of its value today. If you get that integrated well, you get better visibility into where you're headed, and then get your safety stock and cycle stock algorithms retuned to the current environment, that can have a real material impact on inventory reduction, to the tune of 10 to 25% plus, not uncommon.
Great, thanks, Scott. So thanks everyone for submitting great questions throughout the webinar. If you had a question that we did not get the chance to answer, please follow up so that we can have a chance to have a discussion on your question, and let us know if we can be of assistance. We'll have a recording of this webinar available shortly on the TriVista website. It's not always obvious these days what to do and in what order to survive in the short term, prosper in the medium term, and thrive in the longer term. TriVista has specialized expertise and processes. If you'd like our help or simply want a sounding board to discuss options and strategies, please don't hesitate to reach out. Thank you for joining us today to discuss ways to protect value. We look forward to hearing from you. Please stay well, have a nice afternoon, and take care, everyone. Thank you.